Hi, this is Greg Milano, founder and CEO of Fortuna Advisors, and I'm here to talk to you today about the question of, does your executive compensation plan motivate the correct behaviors? Now, first, I want to acknowledge that the challenges that total rewards people face are very difficult, and they come from many different directions. They come from the board, they come from management, they come from cultural differences across different parts of an organization. There are negotiations of target performance. There's the shareholder perspective, which sometimes doesn't agree. There's the employee perspective, which sometimes doesn't agree. There's even the customer perspective that sometimes doesn't agree. ISS and Glass Lewis have an opinion about everything, and they certainly do about executive compensation. Peers do strange things, and then people come in and benchmark them against you and say, they're measuring this, why aren't you measuring that? And of course, there are different kinds of shocks that we face, like COVID-19. And frankly, I don't know why you all continue doing what you do. It's a very tough job. People must say, I'm crazy to get into this business. I really got to get out of here. What if we could make it all really simple? What if we could construct a framework for incentive compensation that basically just says up is good, down is bad. When good things happen, people make more money. When bad things happen, people make less money, and take away a lot of the negotiation and debate and refinement and relief and all the other things that happen to tweak and so forth on an ongoing basis. That would just make everybody's life in this business much easier, wouldn't it? And so I think that would really get everybody back in the game. That's really what I'm here to talk about today, is how to sort of make it an environment where everybody can feel really good about being in the total rewards business, because it just makes so much more sense than what actually happens in a lot of times in companies. To set a foundation for where I'm heading, I'd like to first talk about an ownership culture. And this was an article published by FEI, the Financial Executives International, called Embracing an Ownership Culture, over 3 years ago. And I just want to focus on the right-hand side on the 5 numbered items. These are 5 owner-like traits that we've identified. And when we meet with companies, we often ask people, how well do you think the company matches these traits? And very often they don't think they match them very well. The 5 traits are: spend like the money is yours; extreme prioritization, which is, of course, really important. Companies get bogged down with way too many initiatives; a willingness to experiment and fail; more doing and less talking; and lastly, it's about both the long and short term. It's never about one without the other. An owner would never be hesitant to drive performance as strong as they possibly can, but they also would never squeeze an R&D budget or an advertising budget in order to meet a quarterly number. And so it's about the long and short term, really at the same time. I'm going to show a few people for illustration of points throughout here. The first one I have is Marissa Meyer, and you can read the whole quote, but the important thing about this is she said that she was always trying to do things she was not ready to do, and that's what pushed her into new directions, and that's when you have a breakthrough. And that's really important. All the great things we see in businesses come from this way of thinking. And I wonder, do you think your executive compensation system or your compensation system down through the ranks of your organization actually motivates people to think this way, to think outside the box, to do things they're uncomfortable with? Or does it motivate them to pursue the status quo? We'll explore that in various ways as we go through this. It's important to note that these professors, led by John Graham at Duke University, found through survey that 80% of finance executives were willing to sacrifice shareholder value, long-term shareholder value, in order to meet short-term earnings targets. And I suspect the number's even higher than that, for 2 reasons. One, this study was a while ago, and actually I think this is just getting worse. And secondly, there's probably some part of the 20% that really have this very same behavior, but they didn't want to admit it in a survey. Either they're fooling themselves or they're trying to fool others, but I suspect it's most executives that feel this way. I'm going to go through 4 tips, 4 examples of behavior problems. These are by no means the only possible behavior problems. I just want to illustrate the kinds of behaviors that incentives often wrongfully motivate. And we'll focus on those 4 examples, and then we'll talk a bit at the end about how to find a solution to these that fits your company. So the first example is avoid having too many incomplete measures. So there's 2 points there: too many measures, and you wind up with too many measures because they're all incomplete, and you keep trying to capture different facets of things. And We look at most companies and we find all sorts of measures of different things, and it's almost like, you have a boat that leaks and you plug the leak and then it leaks somewhere else. So you plug that leak and it leaks somewhere else. It's like squeezing a balloon and it just keeps popping out somewhere else. These measures are incomplete, and so by their nature, they encourage bad behavior. And so we think by layering all different measures on top of it, we can plug all those leaks and fix the problem. But the more measures we have, the less people can understand, if I make this decision, will I get paid more? And if they don't understand, if I make this decision, will I get paid more? Why do we even have an incentive to begin with? The whole point is we're trying to motivate behavior, and they have to have some clarity around, if I make this sale, if I make this investment, if I do this thing, will I make more money, or else it's really just a waste of time? How do we expect this to drive the kind of behavior that we want, long-term thinking, like an owner? These are two companies. 5 measures are shown for each of them, company A, company B. On the left, we have a company that has high percentile ranks on revenue growth and operating profit margin, lower on return on invested capital, but still middle of the pack, and then very low on average free cash flow yield and diluted earnings per share CAGR. On the right, we have much stronger returns and free cash flow, a little bit stronger EPS CAGR, but somewhat weaker growth and much weaker operating profit margins. Which one of these companies has better TSR? When I do this in a public room and people answer the question, oftentimes it's about 50-50, and if anything, there's a tilt toward the right, because these days people think things like return on invested capital and average free cash flow yield are really the most important. But if you look at the share price performance of these companies over the 5 years, the one on the right only had 19% cumulative total shareholder return. The one on the left had 279% cumulative total shareholder return. Incomplete measures deceive us all the time. I could go through a whole bunch of these kinds of things. It's like some kind of psychological test, but these collections of measures that each doesn't really tell us a lot about performance don't really get much better when we have a scorecard of them. So what is the unexpected behavior we get? Basically, we're just telling people do a good job. They don't really understand how their decisions affect their pay, and so they just do a good job and hopefully you'll get paid more. Is that really what we want? Is that the best we can do out of our incentive plans? I don't personally think so. The solution is use fewer, more complete measures. Years ago, I was working with a company in London, England, and the finance director of that company, the CFO effectively, was introducing me for a training session. He said something which I've repeated in my book, and I'll repeat sort of quickly here. He said, years ago, we used to pay people based on revenue growth, and then we found that they very often pursued growth that was unprofitable. So we started measuring people based on profit margin. But then we found that once they had a high profit margin, they were unwilling to do anything, even if it was profitable, that would bring down the average profit margin. So then we started looking at EPS, compound annual growth rate. So anything that added to earnings per share, was a good thing. But we found that wasn't focusing people enough on the balance sheet. So we started looking at return on capital, which is like profit or cash flow in relation to the amount of investment in the business. And much like profit margin, it's a percentage measure. So when you're really good, it sets a really high standard before you would want to invest in the business. Otherwise, it's going to bring down the average return on capital. And when you're really bad, you have a really low return on capital, and almost anything will bring up the average. So, companies that use return on capital for the measure often find their poor businesses wind up over-investing in the business because it's easy to bring up the average. And their best businesses under-invest in the business because it's really hard to meet that high standard and raise an already high return on capital. So that's all kinds of behavior problems there. Economic profit, or EVA, was designed to try to fix all this and bring it all together, but it wound up with a bit of a problem in terms of short-termism, if you will, because when you buy a new asset in economic profit, it's very expensive the day you buy it, and then it gets cheaper and cheaper and cheaper as the accounting depreciation depreciates it away. And so that discourages investing, and it encourages milking old assets, which, if you study the markets, doesn't really lead to really good share price performance. And so then there's this measure, which I'm going to talk about just briefly at the end, residual cash earnings. That is a very complete measure. It captures growth, profitability, investment, all on a cash basis. So it doesn't have the problem of economic profit or EVA. But let me just be more general. It's really about finding a measure that is very complete for your business, that captures all the major drivers such that when it goes up, it's good. When it goes down, it's bad. That's a really important outcome of this. That's the solution. Example two, stop measuring against plans and budgets. And I say really because everybody looks at me like I have four heads when I say this, but we want you to stop measuring against plans and budgets. The single biggest cause of short-termism, I'm convinced it's one of the biggest problems in terms of constraining our economy and the stock market and the job creation in the United States. It's measuring against budgets causes sandbagging. We're paying people to plan for mediocrity in the short term, and that's not really a good way to get great success. The technical FP&A term is it's a hockey stick. This is what your plan looks like. The first year is going to be down because I need a really easy target to beat. I mean, you don't say that, of course. You've got all these reasons. There's competitors and there's commodity prices and there's this squeeze and there's that customer doing this and that and so forth. And so next year is going to be a rough year, but after that, the future's so bright I got to wear shades. Well, why is that? Well, because I need to justify all the investment money I'm asking for. So I need an easy target next year and I need a lofty forecast after that. And all that is really triggered by this idea of measuring people against their plans and budgets. The sandbagging comes directly from that. When you think about sports, winning versus losing, and here's a picture of LeBron James, he wouldn't hedge and say, we're probably going to lose before a game just so everybody's really impressed if they win. At the point when I wrote my book, he had an average career over his career of 27 points per game. He wouldn't before a game say, I hope to score at least 6 or 8 points tonight, hoping for praise even if he scores 15. In sports, we don't do things that way. It's absolutist. It's we won or we lost. It's a game that is really very objective and focused on improvement and just winning. So what unexpected behavior do we get when we measure people against budgets or plans? And by the way, I think over 90% of companies out there measure against budgets or plans, but it's a huge behavior problem. The bad behavior we get is people would prefer to plan for 2% improvement and achieve 3% rather than planning for 10% improvement and achieving 8%. Now, if you're an owner, you'd rather improve by 8% than 3%. I think that's pretty clear. But when we measure people against their plan, they are motivated to plan for mediocrity, and this is what you get. The fix is really two-part, and it goes back to example one. Use complete measures, so up is good and down is bad, and then set target performance equal to the prior year. The actual performance in 1 year is the target for performance the next year. If it's a complete enough measure, then that's good performance. That means you've earned an acceptable return on all your new investments. And if you do better than that, that means you've really created value. Well, some of that gets shared with whoever's in the incentive plan. And if you do worse than that, then you've destroyed value, and some of that gets shared in terms of a reduction in bonus payout. Now, as soon as you do that, the behavior changes. No longer are people trying to sandbag their budgets. They're trying to figure out how high is up. And when they come and bring an investment to you to try to approve it, you may or may not approve it. But before you try to think about it, you're going to know they believe their forecast because they're exposed to the outcome. If they make an investment and the measure goes down, they're going to get paid less money. So they've really thought long and hard, like an owner, about whether or not they believe in their forecast. And it creates really a fantastic behavioral dynamic when you start measuring people against last year instead of measuring them against their plan. Example three, don't motivate executives to behave like lenders. I've loved this one for years, and I have to throw back to my former managing partner at a company called Stern Stewart, Joel Stern. He was the one who really started me on this kick. And, it's really a behavior problem. And it's becoming more and more of a behavior problem in some companies where risk aversion is really taking over. What are we talking about when we say paying people like lenders? Lenders play it safe. Right? The best they can ever do is just get back their principal and earn some interest. They have no upside beyond that, but they have a lot of downside if things go badly. So lenders play it safe. They avoid basically all risks. Owners also care about risk, but they think about the trade-off of risk and return. They're willing to take prudent risks, and they want to avoid, risks that are too extreme. And so we want an owner-like behavior, not a lender-like behavior. I don't know if you know Danny Kahneman. He was a psychologist who, interestingly, won the 2002 Nobel Prize in Economics. He has several great books. The most recent one is Noise, which I highly recommend. It's about how we have bias in our decision making that winds up leading us to make decisions that are sub-ideal because of odd things like, if you go to a doctor in the afternoon relative to, versus going to them in the morning, you're more likely to get prescribed opioids in the afternoon than you are in the morning. If you are, on trial and you're getting sentenced on a day after a football game, if the judge's team won, you're likely to get a more lenient sentence than if the judge's team lost. And the book goes on. It's really a fantastic book. I highly recommend it. Anyway, Danny Kahneman said, optimistic people play a disproportionate role in shaping our lives. Their decisions make a difference. They are inventors, entrepreneurs, political, military leaders, not average people. They got to where they are by seeking challenges and taking risks. And so we want a framework that encourages people to take good risks, to be willing to fail when they try to do things. And the downside, if we don't do that, of course, is that when keeping somebody's job is more important to them than any kind of upside or future growth, then short-termism creeps in. They're constantly worried about hitting next quarter, making sure they don't get criticized, and they're unwilling to make those investments that might be viewed negatively in the short term, but they're convinced would be really good in the long term. And that's really negative behavioral impact of the asymmetry of people having more downside risk than upside opportunity. Solution is you have to ensure there's adequate upside and downside. There has to be real variable pay. When people do well in many companies, the targets are set tough the next year to kind of recoup it because they didn't deserve that. When people get paid poorly, sometimes the targets are made a little bit easier the next year to kind of make up for it. And you wind up with pay that hardly, over rolling like 3-year periods, hardly varies with performance. And it's really unfortunate. In some cases, we see it actually have a negative relationship to performance. So make sure there's actual adequate upside and downside and that there's some general symmetry around that to motivate the right behavior. Example 4, be careful how you integrate purpose and sustainability into compensation. It's very popular now, and I think it's a good thing, to be integrating metrics around purpose and sustainability and ESG and other related matters into compensation. I couldn't agree more. If you look at our research on how high purpose versus low purpose brands, as tested by Bera Brand Management, they have a framework for testing the consumer's perception of the purpose of a brand, and the framework was designed in collaboration with Jim Stengel. High purpose brands actually produced better share price performance than low purpose brands. Operating with good purpose is a good thing, even for shareholders. Sometimes when you make the sort of investments in an organization and the stakeholders of an organization that goes along with operating and being perceived as operating with high purpose, sometimes people view it as just a cost. So we need to measure the outcomes of that so we have something to counteract this cost. But in fact, many of these investments actually have a good return. You can imagine that being seen by consumers as operating with high purpose leads to more sales. It leads to premium pricing, leads to all kinds of good things. So there really is a good alignment of shareholders with all of this, even though that's not obvious when you speak to some management teams. But I don't want to go so far as to say, so you don't need to measure and put in incentives, things like purpose and ESG and so forth. I think it is good to make sure that there's both the actual motivation, but also the symbolism of saying this is important to people. And so it is important to put in, but be careful, okay? Let me just talk a minute about Jim Stengel. I mentioned him before. He's the former P&G Global Marketing Officer, and he also has his own company now, the Jim Stengel Company, which is an outstanding advisor on embracing an authentic purpose. He evaluated the report, the predecessor report to the one mentioned on the prior page, and this was his quote. And he says, the companies who activate and amplify their purpose with passion and authenticity are the ones who will win. And I think it's just great. It fits so well with what our research shows. There's one word in there that I think is unbelievably important that not everybody pays attention to. It's authenticity. Authenticity matters. It's very, very important that you bear that in mind. There are so many companies that talk about purpose out there, and they operate in some cases directly at odds with it, in some cases partially at odds with it. Being authentic about your purpose is critical. And how you weave things like purpose and sustainability and ESG into compensation is risky because it may risk this authenticity, which is so important. When you have incomplete or poor ESG and sustainability measures in your executive compensation, what your risk is that it's going to lead people to be in an inauthentic tick the box type of scheme, or what's called greenwashing, where people pretend, to be environmentally friendly and they're not, or ESG friendly and they're not. And there's also no balance among stakeholders. Oftentimes, the measures that are put in relate to one outcome or one stakeholder or one group, and not to others. And so we're saying benefiting this group is more important than benefiting that group, and that winds up driving behavior in ways that's not very authentic and good either. So be very careful. Again, I want to reinforce, I think it's a good idea to put these metrics into incentives appropriate to the particular business and its key drivers, but you have to be very careful to not lead to an inauthentic tick the box type of approach. The solution: comprehensiveness and balance. We want to recognize that long-term value requires purpose and use only complete and unbiased sustainability measures in our incentive compensation frameworks. These are some examples of what can go wrong. Obviously, many things can go wrong. I just wanted to illustrate so you had some real tangible ideas of what kinds of behaviors can go wrong. How can you systematically figure out what bad behaviors you are encouraging? First, get a group of people together, hopefully multi-disciplinary, so they each take a different view at it. Look at the incentive design, look at the financial performance, look at the other measures that you're using, and try to figure out how to game the system. We don't want people to game the system. Well, to design a system that can't game, you should try to game it yourself. They hire experts sometimes to try to break into bank safes in order to make sure that it's solid. It's the same thing here. Try to game it, try to figure it out. What can we do to earn higher bonuses that would not be good or maybe would even be bad for the company? And let's make a list. And then once we have that, let's reduce the number of measures. Let's measure against last year, not against budget. Let's ensure good symmetry of upside opportunity and downside risk. Let's incorporate holistic non-financial measures and other things. Whatever the gaps are that you find that are behavior problems that your incentives are motivating, let's try to find them and let's try to figure out how to solve them. And they may be very different from what I've painted here. These are just the ones that relate back to the examples I've given before. One approach is to measure residual cash earnings, which is a measure we advocate. And I just want to be clear, anything that's a complete financial measure for your business works. This is just one approach. And it's an improved version of EVA, which was popularized back in the 90s. At the time, I was working for Stern Stewart, the company that owned the trademark EVA, and we brought it to many companies around the world. And we did studies that showed that companies that embraced EVA beat their peers on total shareholder return by an average of 8.5% a year. It was great. We created residual cash earnings to capture those benefits while at the same time simplifying it and encouraging appropriate investments in growing the business. I found at the time that many companies that had embraced EVA weren't investing enough in the future. So we've designed a different measure that's cash-based and motivates much better thinking about the future. And I don't have it in here, but just so you know, the measure tracks even Amazon's share price, almost perfectly. It's really a great value creation signal. And when we published an article about this with World at Work, they changed the title of the article, and I think it's great. So I'm going to show you a picture of the article from a couple of years ago. It was called "The Next Game Changer in Performance Measurement." And again, I didn't make up that name, but I thought it was pretty cool. I kind of conveniently ignore that there's a question mark at the end. I view it like it's a statement. You can view it however you want, but this is about residual cash earnings. Varian Medical Systems embraced the RCE framework. The left here are some excerpts from their Investor Day presentation in 2019, where they explained to investors that this would help them create an ownership culture that encourages management to think and make decisions like owners. It would change decision-making to align planning and decision-making with continuous pursuit of value creation. It created balance between growth and profitability, which many companies lack. They grow a lot, but they don't care enough about profitability, or vice versa. These days, it's often vice versa. Too much emphasis on margins and returns and not enough emphasis on investing in growth. And they explained to investors that it had a really strong correlation with TSR. And we've published research showing that it tracks TSR better than EVA, for example, in every industry. So it's good stuff. On the right is the outcome. Varian was acquired by Siemens Healthineers, and I think they're going to have a very strong and positive future together. I think it was very good for stakeholders, that particular acquisition. But before that happened, if we looked at what happened after Varian embraced this framework, growth that had historically been very high, but in recent years was low single digit, suddenly jumped back up into double digit range. And, over time, the share price doubled, which is a good outcome too. And then that's basically what I have to present. So please, let's go right into the Q&A mode now, which I believe is going to be live.